Hey everyone, welcome in to another daily editorial here on the KE Report. We are chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Now, Jordan, today the big event on tap is the Fed meeting and statement by Jerome Powell. We are recording this about 45 minutes before we are going to get at least the meeting notes and then the Powell press conference. I know you don't make any trading advice or moves around these Fed meetings, and you really like to ignore what the Fed is saying and truly look at what the market is telling you about, hey, what their taper process might be, if they are going to raise any rates, because it is such a critical event for today, and the markets really have been, in a way, handcuffed throughout this week, even though I think we know what the Fed's going to do today. What's your takeaway? What are you going to be watching on the back of the Fed statement, and what do you think is important for investors to understand as we move past this Fed meeting?
Well, as you said, I think we have to follow the market. I've been more keen on the rate hike aspect of it, and so looking at the market, I think the market has priced in basically three full rate hikes for the entire 2022. I've been following the date on when the first hike is going to be, and it basically, as of right now, this is subject to change over time, but as of right now, the market is pricing in the first hike in May or June, which is not too far away. And so, with respect to precious metals, around that time, if that's when the first hike comes, that's when we're, based on history and all the other things I'm looking at, that's when we're likely to see a significant rebound begin in our sector for the first time in a while. So that's the thing that I'm really thinking about. As far as the more near term and short term aspect, precious metals, the stocks over the last week or so, they had rallied up close to the 200-day moving averages across the board. But in the weekly chart last week, they put in a bearish reversal without even, they got pretty close to the 200-day moving averages, but they didn't quite touch them. And so they put in a bearish reversal on the weekly chart. So that is worrisome, along with the price action in gold, which it was last week. I think it made it up to 1815, then it sold off and it dumped lower at the very end of the month on Friday. And we're seeing some follow through with respect to that today. So even if you just pull the Fed out of the equation, the trend in precious metals in a short term sense is worrisome because the rally reversed course at declining moving averages, so moving average resistance. And, at the same time, we're coming up on potential tax loss selling this month and most of next month for juniors. And, we've been talking about the fundamentals. The stock market made another new all-time high. So the correction that we had a month or two ago, that's all but gone. The advanced decline line is making new highs for the stock market. So, the dollar had a pullback. It's rallying a little bit. So when we look at all these factors, the current trend is, it's up for the stock market, it's down for precious metals. And so, sure, the Fed can say something that might impact that a certain way for a couple days or a week, but it's really nothing that should factor too much into your investment process. And so, I like to say rather than worrying about the Fed, spend that time calling one of your companies or researching more companies. You're going to be much better off in the long run by being an expert on the companies you invest in rather than worrying about, what these economic mongoloids might say one way or another, because they just tend to follow the market eventually.
Jordan, I think that's such a great point to focus on the mining stock, something you can control, your information, your knowledge on the market and on the companies and what they're doing. But just to take one more step back, because I do like your perspective on intermarket analysis and looking at other markets and how they relate to the precious metal sector. I think that's key. And you look at technical analysis, which cancels out a lot of the short term noise, anyways. But when you hear investors coming to you, or you see them in the marketplace, or you see them on Twitter talking about, the Fed's going to do this and 2022 and they can't really hike or the whole system will explode, or Basel III's coming, it's coming, the banks are going to buy physical, the physical markets are going to get bigger and they're going to swamp the paper markets, or all these other narratives that you hear people do. You're able to look through all that noise and just focus on the market reaction. Would you unpack that a little bit more for folks that maybe invest their time in the wrong areas?
Yeah, I mean, look, market analysis and following technicals, it's really, really hard. And so I just think a lot of people don't really have the experience or the know-how. And that's not to say that I here have all the answers and I know everything, but I can just, over following this market for almost 20 years, what I try and do is look at the fundamentals as well as, the macro fundamentals as well as the technicals with respect to intermarket analysis because gold is a market that it's really connected to the other markets. Where if the other markets are doing well, you're going to see gold struggle, and that's a simple fact. At the same time, if you look at just Fed policy over the last 50 years, it's amazing how the start of the Fed hiking rates or the start of the Fed cutting rates, like the start of these different Fed cycles, they a lot of those tend to follow bottoms actually, which is interesting. So, I mean, that's something when the Fed shifting policy, I mean, that's something I talked with Corey about a couple years ago, how that was going to be a big thing in 2018, or at least in 2017, before it happened. And, over the last, several months, we've been talking about the Fed hiking rates because this is just something historically we look at their decisions and how that is matched up along with the movement in gold and gold stocks. When you're looking at technical analysis, try and keep it as simple as possible. Look at the price action, look at how gold is performing relative to the stock market, and also against foreign currencies, and that tells you a lot because for gold to have serious big moves, it usually has a positive divergence against foreign currencies. And at the same time, it tends to be a little bit stronger than the stock market when it starts these moves. So I factor all those things in. And then at the same time, I just look at the general price action. What is the trend in the market? Where are the moving averages, the 200-day and the 400-day? Where are those going? And so with this correction, gold, I don't know at what point we could say, but over the last year or so, I mean, this correction, it got, it lost the moving averages, so it's been below the 200-day. The 200 days pointing down. Gold has rallied above it a couple times. I think it did so for a day or two last week, but the moving average is still pointing down. And looking at the price action, that tells us that the market is still on the downtrend. And I've said, we have to have a stock market correction or the Fed has to hike rates. And so based on everything I'm looking at, those have been the things that I've been considering for, what can really get this market back into a bull market. And at the same time, you have to look at the very big picture where, for example, I look at the 40-month moving average for gold. Go back 40 years or so. That's been a significant moving average as far as support and resistance. And so gold is still above that moving average. The long term, the very long term historical chart is showing a cup and handle pattern. We're in this handle, which I may have said in August when we started to correct. I said, this could take 18 months, maybe even 2 years. So, you have all these things that you're looking at. It's like you have this big puzzle and you're trying to fit all these things in there. And at the same time, getting back to some of the things you mentioned, the problem with a lot of these things is it's something that Bob Moriarty wrote in one of his books, like it's signal versus noise. Signal has something to do with data. Like there's actually data there, it's objective, you can follow that. Whereas there's noise where it's the opposite. It's completely different. So a lot of the things you mentioned there, the Basel III, or they're going to do one hike and the whole system is going to come down. I mean, all these things, all of that stuff is noise. It doesn't help your investment process. Anything that you're looking at, I mean, there has to be some kind of objective data behind it. If you want to say the whole system's going to come down or the stock market's going to crash, I mean, that's fine, but at least look at Fed rate hike cycles and historically see how many hikes they do, before the market goes into a bear market again. I mean, that's a legitimate way you could look at it. So, I mean, I know this has been a long and jumbled answer, but I just try and look at all these different things and put them into a one single puzzle. But it's so important to focus on things that are objective and not things that are subjective and noise. And that's the problem with a lot of people in this sector is, they have these narratives and they can't really be backed up by data one way or another. And it's not just the perma bulls, it's also the perma bears who are talking about how the whole thing's going to collapse. Gold's going to go to 700 and then it's going to go to 7,000 after that. Like they keep saying the same thing over and over and over again. They never change their mind when the data changes, and so it's cognitive dissonance on both sides, and we have to be careful about that. And circling back to my last answer, I'll just conclude by saying, at the end of the day, become an expert on the companies because that's going to help you more in the long run by being a good stock picker.
It always comes down to the companies, right? But you are right. There is a lot of noise in this sector, but in all fairness, it's true for, I think, every sector where there are always some permabulls and they will find whatever reason they need to be bullish, even though the true data doesn't back that up. Jordan, just a quick question though, because you compare a lot to how the markets or how the precious metals are doing compared to US markets. How did the bond market fit into all of this with yields? This also combines with what the bond market is telling us about the Fed's rate hiking potential here into next year. What's critical to understand about bond market moves and the fact that generally yields have moved higher this year?
Well, that's a great question. I mean, the bond market is very, very tough, and the bond market is going to tell us a lot, especially next year. I mean, I think you're looking at the data, it's fair to say the Fed's going to hike once or twice, but if the data were to soften a little bit and you see long-term bonds, if you see yields, they don't move up next year, that's going to bring about obviously a lot of questions about did the Fed make a policy mistake? Can they hike more than one or two times? Are they going to take a year-long break like they did after that one hike at the end of 2015? So the bond market will tell us a lot in that respect because assuming if we make the assumption the Fed will be able to hike, then the issue after that is are we going to see inflation remain firm and growth high enough where the Fed can do a couple more hikes? Or, I mean, if long term yields are not rising and they kind of fizzle out next year on a bigger scale, that's telling you maybe they can only do one or two hikes and maybe they have to shift policy again and will do something else because if they only do one or two hikes, I mean, they have no room where they can really cut after that. So, yeah, I just think that the bond market, it's so difficult, but it's really going to be the key next year to tell us how much the Fed can hike. Where is this cycle going with respect to are we going to see inflation stay sticky? Might it even accelerate a little bit, after next year or late next year? Or is it going to kind of fall off again and we get into this disinflationary thing where you have 1 or 2% inflation again and growth is pretty low? So there's a lot of different things that can happen next year, and the bond market is going to be a good answer with respect to all those things. And I think in most cases, the precious metals are in pretty good shape with respect to how the bond market will act next year. So I mean I will say that I am given how everything's setting up. I mean I am more bullish on precious metals next year, but the bond market is going to help tell us whether inflation is really going to be sticky or if we're going to see growth numbers and inflation kind of turn back lower again, and then we have these deflationary worries again, even though it's just really disinflation.
A lot of balls in the air that we have to keep our eye on. And honestly, on a lot of these things, as you've been saying, we just have to wait and see how some of these trends play out. So, in the meantime, while investors are waiting for these trends to play out and to see which way the markets go, you mentioned doing your homework and researching companies and looking at the mining stocks and seeing which ones catch your eye. Is there a particular area or subsector you're looking at? Are you more interested in producers, royalty companies, developers, exploration stocks, prospect generators? What subsector has your attention when you're doing your homework right now?
Well, first, I would say definitely not prospect generators. Although I did notice one of them has had good drill results recently. But aside from that, I'm mostly focused on producers and developers. I mean, right now, the thing that I like about those is their outcomes are more predictable. I mean, I can assess where they might be in 2 or 3 years, if they grow production, or if they build a mine, what's their capital structure going to look like? How much are they going to cash flow at 1,800, 2,000 gold, that type of deal. Those are the ones that I'm most focused on because the outcomes are more predictable. I mean, if we see gold, rise above 1,900 next year, or everything gets bombed out when the Fed hikes. I mean, in that scenario, I might look at, more explorers and more optionality type plays. But they're secondary to my main focus because the producers and developers, again, I like that the outcomes are more predictable. And to be honest, I mean, these companies perform the best if there's some production growth there. So that's what I really like. And I'll throw in, because I was talking to you guys about this off mic, if you're a fan of exploration, by producers. And I say that because the producers that have exploration success, I always give these examples, go back the last 3 or 4 years. I mean, Kirkland Lake, Wes Dome, K92 Mining, three of the most absolute successful producers, and they all had a significant amount of exploration success. And the thing is, with this exploration success, you don't even need to necessarily like predict they're going to have great drill results. You can just look at their drill results, talk to them, understand where they're having some success, where it's going to help impact the business. And, if that's the case, those results tend to get, in most cases, they will get better over time with respect to adding more value to the company. And we could be coming into a tough 2 to 4 or 5 months here, tax loss selling, and the Fed getting ready to hike rates. And so while that's super bullish for the sector, the very beginning part of that is bearish until they actually hike. And so that means, I know I've probably said this before, but honestly, with this rate hike coming, the next 2 months for tax loss selling, then 3, 4, 5 months for some of the larger companies potentially. I mean, this is a window where this is like a January, a 2016, or a summer 2018 type window we're coming into, where you're going to have a really really good buying opportunity, where the market is getting ready to put in a significant low. And so, we could be in a period where good news kind of gets ignored, or good drill results by producers. The market doesn't care. So it's going to be I don't want to say a once in a lifetime opportunity, but it looks to be a really, really good opportunity coming in the coming months. And so, now is the time to get ready and, start researching these companies and become a real expert. And so, yeah, yes, I'm mostly focused on producers and developers, but at the same time, there are some other companies that I have in the back of my mind, in case they really get bombed out, or we're moving. I'm more interested in those as we move very, very close to what looks like a bottom in the sector.
All right, Jordan, we're going to wrap it up there. And to one of your points there, it's unfortunate that we've actually been in that environment for a while where good news can actually be a selling event for some of these stocks. Although the odd good news actually does drive some of the select few high flyers in terms of the resource stocks higher. Always great chatting with you, Jordan. I know you will be waiting patiently for that Fed statement later today. I am saying that in a very sarcastic way, but we will be chatting with you next week, and we'll get to see just how the markets and metals react on the back of the policy change, I guess, today from the Fed. Jordan, thanks as always for your time, bud. We'll chat again next week.